If you're a midlife homeowner working to manage your mortgage more efficiently, refinancing can be one of the most impactful strategies available. With 2025 interest rate forecasts projecting averages around 5 to 6%, many homeowners currently locked into higher rates could benefit from refinancing to reduce monthly payments and long-term interest costs. Even a 1 percentage point drop can translate into thousands of dollars saved over the life of a loan, freeing up cash for retirement planning, investments, or debt reduction. However, refinancing isn't just about chasing a lower rate. It's essential to consider the full financial picture. Closing costs, lender fees, appraisal expenses, and the length of the new loan term all influence whether refinancing results in true net savings. Some midlife homeowners choose to refinance into shorter terms to build equity faster, while others extend the term slightly to ease monthly pressure. Each choice depends on your broader wealth-building goals. In this guide, we'll break down when refinancing makes sense, the key indicators to look for, and how professionals in their 40s and 50s can use this strategy to optimize long-term financial stability. Whether your goal is faster payoff, lower monthly expenses, or improved cash flow, a thoughtful refinancing approach can be a powerful step toward strengthening your financial future.
Hi, welcome to SmartCents. In this channel, we talk about personal finance for mid-career professionals over 40. This is for people who think they've missed the financial bus. We're here to show you it's never too late to hop on and accelerate toward wealth.
Refinancing your mortgage can be one of the most effective strategies for improving long-term financial stability, especially for homeowners over 40 who are focused on building equity and preparing for retirement. When you refinance, you replace your existing mortgage with a new loan that offers better terms, typically a lower interest rate, a shorter repayment period, or both. According to Forbes's 2025 forecast, average mortgage rates are expected to fall into the 5.5% to 6.5% range, creating an attractive opportunity for homeowners currently paying higher rates. Even a modest rate reduction can have a significant impact. For example, dropping from a 7% rate to around 6% on a $300,000 loan can save roughly $200 per month, adding up to substantial long-term savings. Homeowners can choose from various refinancing options, such as rate and term refinancing, which focuses solely on improving loan terms, or cash-out refinancing, which allows you to tap your home's equity for major expenses or investments. However, refinancing isn't free. Closing costs typically range from 2% to 5% of the loan amount, making a break-even analysis essential. In most cases, staying in the home for at least 3 years ensures the monthly savings outweigh upfront costs. For midlife homeowners, successful refinancing can accelerate equity growth, reduce interest expenses, and free up additional cash that can be redirected toward retirement planning or other financial goals. A rate and term refinance is one of the most straightforward refinancing options available to homeowners, especially those looking to improve their mortgage terms without tapping into home equity. As the name suggests, this type of refinance adjusts either the interest rate, the loan term, or both, without providing any cash back. According to Bankrate, rate and term refinancing is most beneficial when market interest rates fall by at least 0.75 percentage points below your existing rate. That difference may appear small, but over the life of a mortgage it can produce meaningful savings. One common use of this refinance option is shortening a 30-year mortgage to a 15-year term. Homeowners who choose this path often benefit from significantly reduced interest costs over time, allowing them to build equity much faster and position themselves for a more secure retirement. Approval for rate and term refinancing is typically simpler than cash-out refinancing because lenders view it as a lower-risk loan. However, homeowners should be mindful of the upfront expenses. On average, closing costs can total around $5,000, which means running a break-even analysis is essential to confirm long-term savings. This type of refinancing is best suited for borrowers with steady, reliable finances who can handle the adjusted payments comfortably. Overall, a rate and term refinance can be a powerful tool for midlife homeowners aiming to streamline their mortgage and strengthen long-term financial stability. A cash-out refinance allows homeowners to tap into the equity they've built and convert a portion of it into usable cash. For many midlife borrowers, this can be an appealing strategy, especially when the funds are used to pay off high-interest debt. For example, replacing credit card balances at 21% interest with a mortgage rate cash-out loan at 8 to 9% can dramatically reduce monthly payments and long-term interest costs. According to Yahoo Finance, Cash-out refinancing tends to work best for homeowners who have at least 20% equity in their property, ensuring they maintain a strong financial cushion after withdrawing funds. The main advantage is the ability to consolidate expensive debt into a single, lower-interest mortgage payment. This not only simplifies budgeting but also frees up cash flow that can be redirected toward retirement savings, emergency reserves, or other financial goals, an important priority for borrowers in their 40s and 50s. However, cash-out refinancing also comes with risks. Because you are increasing your mortgage balance, you take on more long-term debt and potentially extend the payoff timeline. It also raises the stakes. Failure to repay a mortgage carries foreclosure risk, unlike unsecured credit card debt. For midlife borrowers, lenders typically cap cash-out loans at 80% loan-to-value, LTV, to maintain financial safety. Used wisely, a cash-out refinance can be a strategic tool, provided the benefits outweigh the added risk. Refinancing your mortgage can be a smart financial move when market interest rates drop sufficiently below what you're currently paying. According to Investopedia, the general rule of thumb is to consider refinancing when rates fall by at least 0.75 percentage points. This difference is often enough to generate meaningful monthly savings, especially on larger loan balances. However, determining whether refinancing truly benefits you requires completing a simple break-even analysis. Divide your total refinancing costs, such as closing costs, appraisal fees, and lender charges, by the expected monthly savings. The result tells you how many months it will take to recover your upfront expenses. A successful refinance also depends on your financial profile. Strong credit and stable income are essential, as they help you qualify for the lowest available rates. Homeowners who are planning to move in the near future may want to skip refinancing, since they may not stay in the home long enough to reach their break-even point. Likewise, borrowers who are underwater, owing more than their home is worth, may not qualify for traditional refinancing options. For many midlife homeowners, timing is critical. Forecasted rate dips in 2025 could provide a well-timed opportunity to refinance, lower monthly payments, and strengthen long-term financial stability. Building an effective refinancing strategy requires evaluating multiple options and understanding how each one affects your long-term financial stability. One of the best starting points is to compare offers from several lenders, ideally 5 or more, using tools like Credible or other rate comparison platforms. Reviewing multiple quotes helps you identify the most competitive interest rates, lowest fees, and most favorable loan terms for your situation. Online mortgage calculators are another essential tool. They allow you to estimate monthly payments, potential interest savings, and break-even timelines so you can clearly see whether refinancing is worth it. For borrowers considering a no-closing cost refinance, it's important to understand that these loans roll the upfront fees into a slightly higher interest rate. While this reduces immediate expenses, it may increase total costs over time, making it more suitable for short-term homeowners. For people in their 40s and beyond, a hybrid strategy can offer valuable flexibility. This may involve pairing a traditional refinance with a HELOC, home equity line of credit, giving access to funds for emergencies, home improvements, or debt consolidation without committing to a large cash-out refinance. Because cash-out refinancing and HELOC withdrawals can have tax implications, consulting a financial advisor is highly recommended. Advisors can evaluate how refinancing affects your taxes, retirement contributions, and overall wealth building plan, ensuring you make confident, well-informed decisions. Refinancing can be a powerful tool for midlife homeowners, but it also comes with important pitfalls that should be evaluated carefully. One of the biggest considerations is timing. Because refinancing involves closing costs and various lender fees, it only makes financial sense if you plan to stay in the home long enough for the monthly savings to outweigh those upfront expenses. Homeowners who expect to move within a short period may find that fees quickly erode any potential benefit. It's also essential to monitor broader economic conditions. Federal Reserve policy significantly influences mortgage rates, and in a shifting economic environment, such as the volatility expected in 2025, patience can pay off. CBS News highlights that waiting for clearer rate trends or further dips may lead to better refinancing opportunities, especially for borrowers seeking meaningful long-term savings. For those considering a cash-out refinance, discipline is crucial. Only withdraw what you truly need, whether it's for debt consolidation, home repairs, or emergency expenses. Preserving as much equity as possible is vital for protecting your long-term financial security, including retirement planning. Tapping too much equity can leave you exposed if home values decline or personal circumstances change. By approaching refinancing thoughtfully, analyzing costs, watching rate movements, and borrowing conservatively, you can avoid common pitfalls and make decisions that genuinely strengthen your financial future. You now have clear refinancing strategies tailored for midlife financial planning, so take a moment to evaluate your options. Use the free checklist below to guide your decisions. Many homeowners save thousands by refinancing smartly. If this content helped you, remember to like and subscribe for more practical guidance. Up next, we'll explore smart ways to manage and refinance your car loans.